Good noon to everyone. This is Dr. D. Kutika, Associate Professor, Department of Commerce with Computer Applications, Dr. Snsinstitutions College of Arts and Science. Today we are going to discuss about the time value of money in investment decisions in the chapter of your financial management. So the time value of money is nothing but this concept can be explained in a very easy way. That is, it recognizes the principle that a dollar today is worth more than a dollar in the future due to its potential earning capacity over time. So this is known as your TVM, that is your time value of money. For our understanding, let us have it as TVM in this video to understand the term time value of money. Understanding TVM, it is a very crucial in investment decision because it allows the investors to evaluate the value of the cash flows occurring at different points in time and to compare investment opportunities on a consistent basis. Here is how that particular TVM affects the investment decisions. One is discounting future cash flows. TVM helps in discounting the future cash flows, that is by applying the appropriate discount rate. And next one is regarding your net present value analysis, NPV. It is a common method in your investment decision that applies your time value principles. It involves estimating the present value of future cash inflows and outflows associated with the investment. So it calculates the cash inflow and cash outflows and compare the net present value to 0. So this is the way in which we are going to calculate in case of your NPV. So when we have a positive NPV, it indicates the investment is expected to generate returns greater than a required rate of return and vice versa. And then next one is regarding is your capital budgeting. TVM plays a very important role in your capital budgeting by discounting the cash inflows from the projects back to the present value using a hurdle rate. These companies can determine about this particular value. Then next one is regarding your internal rate of return, that is your IRR, is another commonly used investment evaluation metrics that takes into account the time value of your money. So here IRR represents the discount rate at which the present value of the investment cash inflows equals the present value of cash outflows. So investment inflows and outflows are considered here, and it compares the IRR to the investors compare the IRR to their required rate of return to assess the attractiveness of an investment opportunity. And next is regarding a risk and uncertainty considerations. TVM also helps the investors incorporate the risk and uncertainty in their investment decisions by way of finding out the best projects by analyzing the risk and uncertainty considerations. That is your discount rate, how it reflects, and what about your trade-off. Everything can be compared with the help of your time value of money. Then comparing investment alternatives. TVM allows investors to compare investment alternatives with different cash flow patterns, durations and timing. So this is a best way in which we can analyze about your investment alternatives. By discounting all cash flows to their present value, investor can assess the relative attractiveness of the different investments and choose the option that offers the highest potential return for a given level of risk. So these are the way in which we are going to understand about the in a way in which we are going to analyze about the time value of your money. Okay, so in that time value of money we have different methods. What we have seen, I'll give it as a crisp. One is your discounting future cash flows, another one is your net present value method, another one is your capital budgeting, and then internal rate of return. In short, we say them as your IRR, and risk and uncertainty considerations, where we are going to take more informed decisions about the risk return trade-off of different investment opportunities. And again, next one is regarding the comparing of investment alternatives. Here we have considered all your investment alternatives by way of different methods using your time value to understand whether that particular project is feasible or not, and whether we can undertake that particular project. So comparing the alternatives is most important when we are considering the time value. So considering all the other factors into our consideration, we are going to find out the best project using the different methods which is available with the time value of our money. So the time value of money is most important factor in the financial management, which helps us to understand which projects alternatives is feasible to us. So thank you for watching. Thank you so much. Kindly keep in touch and keep on going with my further videos also. Thank you.